Seneca Partners is an award-winning specialist SME investment business. Formed in 2010 and headquartered in the northwest of England, Seneca has over 100 million of tax-advantaged investments under management, which provides equity and debt funding for UK SMEs. Seneca Partners is also the founding member of the Seneca branded network of companies. And today I am delighted to be joined by Matt Currie, who is Seneca's investment director. And today we're going to be chatting about the Seneca Growth Capital VCT. Matt, welcome.
Thank you, Catherine. Nice to be here.
With regards to the Seneca Growth Capital VCT, the current and recent raises have been on the 2018 launched B shares. What is the difference between the two share classes and what is the focus of the B shares?
So the B shares are, as you mentioned, are our most recently launched share class. The ordinary shares that were in place prior to Seneca's involvement, they're effectively a legacy share class that's been in place for many years. That particular part of the VCT was originally established as a biotech-focused share class, and as such, its portfolio has not been active for a number of years. And the VCT board were tasked with effectively running that portfolio down and extracting maximum value for the legacy shareholders of the ordinary share class. The B shares are effectively kind of the future of the VCT, and that was the rationale behind Seneca getting involved in 2018 and taking the role of investment manager of the VCT on in 2018. So that's been the active share class essentially for the last 3 or 4 years, raising funds and deploying those funds under more of a generalist strategy since that date. So we've been investing the cash and the funds that have been raised into a blend of AIM and private companies, very much with a generalist strategy across a number of sectors. So we raised towards 20 million, or almost 20 million since inception in 2018, and as I say, that's the future of the VCT and the more active from an investment perspective.
The VCT invests in both AIM growth companies and private companies. What's the split between the two, and what's the advantage to investors for this?
The split is broadly 50-50. Obviously, the AIM market it can be a little bit more volatile in terms of investor appetite and deal flow. It kind of comes and goes a little bit more with investor sentiment. So at the moment, the portfolio is sat with 20 companies that are in there on the whole, 12 of which are AIM listed businesses and 8 of which are private. We would essentially expect that to kind of follow that broad 50-50 trend over time, and we've been active in both AIM and private businesses across the portfolio since inception. In terms of the AIM opportunities and the benefits of that as a whole, clearly the number one benefit from our perspective is liquidity and the ability to kind of actively manage a portfolio of AIM investments, the ability to de-risk those investments over time and work towards target exit prices and blended returns across a number of funding rounds and a number of transactions. On the sales side, is something that's very much appealing to us as a portfolio manager. The other benefit, or the other key benefit that we see on the AIM side, is the ability to work with and invest in potentially more mature businesses, better established, but probably greater in size as well. A lot of the companies that come to the AIM market versus what we see on the private side. Obviously, that's not the case for all of them. You can get some really nice substantial businesses on the private side, and you can get some relatively early stage businesses going on AIM. But I think as far as the average transaction goes, you certainly the AIM market does seem to have it seems to attract, and obviously the regulation and reporting requirements that follow on AIM work very much in favour of the more professional and well-established businesses. On the private side, as I say, we still see a broad range of opportunities in terms of private opportunities. That again comes with a number of benefits. We can work much closer with management teams. We can really get under the skin of the business. We can get effectively live data and management information to be able to add that value to the portfolio companies. And often the private opportunities tend to carry a slightly more conservative entry value, so you can get involved at a slightly more opportunistic funding round or get on board a sensible valuation versus when the AIM market is kind of buoyant. You do tend to see a little bit of froth creeping into people's valuations. So it's very much a case of us kind of managing that across the AIM opportunities and the private pipeline, really.
Matt, what's the target dividend, and how do you see this being maintained?
To date, we've been we're on track to pay 3p a year, which has always been the stated target dividend since inception. The ambition is to uplift that to 5% as of 2023. Now, obviously, that still remains the ambition, and we're still relatively comfortable that that's achievable. What I would say is it is still it's very much an ambition. Timing wise, that's with the macroeconomic climate the way it is. There's probably a shift in a number of VCTs to maintaining a relatively conservative target in terms of dividend policy, but we're still very much on board with working towards that 5% target for next year.
Does the ability to invest in AIM companies increase or decrease the chances of special dividends?
I would probably say it probably depends. I think it probably makes them more likely because, as I said, essentially special dividends are driven by exits and positive exits, which is probably something that, going back to a previous point around the liquidity on the AIM market, is probably more achievable with AIM investments. Having said that, they may not be as substantial. I think a lot of the winners on the private side will probably generate greater returns if you're back in a business slightly earlier stage with and kind of working alongside that business for 3 or 4 years. You probably would expect a greater return than you would do if you're investing in a business that's already relatively mature when it goes on the AIM market. So I would say the chances of achieving exits that steer you towards paying special dividends are probably greater by investing on AIM, but they're probably naturally, because of the stage you're getting involved, they might not generate the same returns as they would do for a very, very successful private exit. So they might not be on the same scale as a special dividend that comes off the back of a substantial private exit.
Now, Seneca Partners is based in the Northwest. Where do you source most of your investment flow?
The vast majority of our of investments that we actually undertake come through the Seneca network of introducers, friends, contacts, and an awful lot of those are investors in our funds. So we stay quite close to our bank of high net worths and work quite closely with. We have an in-house corporate finance team at Seneca that we work quite closely in terms of businesses that they're retained by or businesses that they work alongside, and these people are very much kind of leaders in their field, and as such you tend to get much higher quality deal flow than we do from what I would classify as maybe a professional introducer, like an advisor or a broker. Notwithstanding that, we do get by quantum, we do get an awful lot of opportunities through advisors, accountants, corporate finance people out there in the market. And obviously, crucially, as we've touched on, we do see a substantial amount of deal flow on the AIM market. So a lot of the operators that are in and around the AIM market are regularly showing us investment opportunities, both businesses that are already on the market or looking to join the market, but also businesses and contacts that are in and around their network that they're potentially looking at introducing to the market within kind of 12, 18, 24 months. So that they're quite often a source of strong deal flow with a clear pathway to joining the AIM market in the near future.
Matt, which sectors do you see the most opportunities for the VCT currently?
As I touched on, we're very much generalist investors, so we have the benefit really of being able to look across all sectors, and what that gives us is the ability to really kind of pick out pockets of value. I think what we've seen over the last 12, 18 months that we're probably still expecting to continue is a backlog of opportunities in and around the biotech and the medtech space that have potentially been underserved and underfunded throughout the last throughout the global pandemic and the focus on COVID and COVID related opportunities. I think there's a backlog of other areas in the medtech space that very much need that funding and need to come to fruition, because there's we all hear the stats around NHS waiting lists and all that kind of stuff that's going on throughout the world, and I think there's going to be some interesting and exciting opportunities to invest in a number of spaces in and around the medtech space. Probably our other main area of focus is from a sector perspective is business to business technology. And really that's probably not changed over the last few years, and it's an area that we're still keen to deploy funds into, and seeing some really strong opportunities, businesses that are solving real problems, and very much kind of in the must have rather than the nice to have category, which I think with the uncertainty that's probably out there from a macro perspective and an economic perspective, I think falling into that category of kind of essential business tech is something that we very much like, and we think makes those businesses very much defensible going forwards.
Matt, finally for today, what's been the performance of the B shares since inception?
So in terms of the portfolio, we investment wise, we've had 7 realizations to date, both full and partial exits, and they've come at an average of just under 2 times return. We've maintained that dividend track record on target of paying 3p a year. What I would say from a NAV perspective, we obviously have a great deal of or a certain degree of AIM exposure within the portfolio. So it's potentially slightly, our VCT being slightly younger and having that AIM exposure is potentially slightly more volatile in terms of an overall NAV perspective. But I think what that does give us is first and foremost the opportunity to invest on AIM, which we see as very much an exciting prospect for the VCT, but also I think with it having a slightly smaller portfolio than some of the larger competitors gives us the ability to generate real value within that portfolio and deliver, as you can see from those exit stats, some impressive exits along the way.
Matt, that's all we've got time for today. Thank you so much for your time.
Thank you.